Hi, everybody. Welcome. Thanks for joining us today. We're really excited to get started for this webinar. Just a quick note, in the question and answer section, you'll see just a few posts on there with some useful links for additional COVID resources for your business. So go ahead and check that out. And there will also be, we have a live Q&A, so by all means submit your questions and we will get to them probably at the end, but we will be getting those questions, so feel free to submit them. Our presenter today is Nathan Larsen. Nathan is a CPA and wealth advisor for Squire. His focus is financial planning and tax. He enjoys helping his clients with all areas of finance and tax strategies. He was born and raised in Utah County, and Nathan has a bachelor's degree from Utah Valley University in accounting and a master's of business administration from Utah State University. So we'll go ahead and turn that time over to Nathan. And again, please feel free to submit any questions in the Q&A. Go ahead, Nathan.
Okay, welcome everyone. I'm excited to talk a little bit about market volatility and then talk about Social Security, which is a great topic for retirement planning. So I'm just going to go ahead and jump in and get started. Okay, starting off, I just wanted to hit on the concept about emotions. We're all emotional when it comes to money, and the more we can separate our emotions from our money decisions, the better off we will be. And so this cool little picture shows that kind of what we want to avoid, which is trying to time the market based on our emotions. So thinking recently about what's happened with coronavirus and the market being down, and we're going to get into that a little bit later, but we do not want to sell while things are down and buy when things, wait for things to get better and buy when stock prices come back up. To be a successful investor, you need to buy low and sell high. And if we let our emotions get in the way, we will tend to buy high and sell low, which is what we want to avoid. So there's an old Chinese proverb that says, yesterday is history, tomorrow is a mystery, and today is a gift. And if you think about stock prices, it's a good way to keep it into perspective. We don't know what's going to happen tomorrow and in the short term. The past is kind of history, and we don't want to worry so much about that. But what we want to focus on to be a successful investor is what we can control and what our decisions need to be today in order to reach our goals. And just keep in mind, this is not meant to be investment advice. This is just a general market overview. And then I'm going to talk about Social Security later. But past results are not guaranteed to continue in the future. And just want to make that clear up front. But the point here is just make sure that we come up with plans that are unique and specific to our goals, and that we keep our emotions from driving our money decisions. Okay, with that said, it's obvious the global stock market hasn't had the best year so far. Here's a cool chart that shows the growth of $1 between now and May 12th. So this is about a week old, but if you notice, things were pretty steady until coronavirus hit and government started shutting things down and businesses started having to readjust, and the stock market kind of went down. And interestingly enough, March was a really rough month, and you can see we kind of hit the bottom sometime after March 20th. And then April was one of the better months that we've had in a long time, and things started to recover. And if you also notice, the graph, it's a little bit flat at the beginning of the year, and then when things started becoming more uncertain, you get the teeth, the ups and the drastic ups and downs that make the graph look more like teeth, and that's just kind of natural when the world is uncertain about economic conditions. The other thing that happened is we have this wonderful Federal Reserve that helps to kind of steer the massive economic ship in ways by reducing interest rates or increasing interest rates, and there's a few other things they've been doing. But interest rates have fallen significantly as well, and so a 10-year U.S. Treasury, just for example, at the beginning of the year was 1.88% per year. That's pretty low to begin with, and then the Fed went in and lowered rates to try to stimulate or reduce the impact of the coronavirus on the market. And now interest rates are extremely low, basically zero. A 10-year Treasury yielding only 0.69% is very, very low. So this next slide here just kind of shows some of the benefits of diversification. So I've got the stock market returns since the peak of February 19th on the left here, and then we've got real estate and a few other things in there. This is obvious. Stocks have gone down, but look at the far right. We've got diversified fixed income. So that's a really conservative fixed income portfolio that has actually gone up, and it's crazy because with interest rates as low as they are, fixed income, the return on fixed income year to date, well, since February 19th is 3%, which is great. And that's why we want to diversify. I mean, nobody wants to invest in fixed income right now with interest rates as low as they are. But the purpose of fixed income in a portfolio is to reduce risk. And this shows that very well, that's exactly what happened. Is fixed income stayed, it maintained its value, earned a little bit, and while stocks were kind of struggling. Okay, this is one of my favorite pictures that helps to put things in perspective. So this goes way back to 1927, and it shows the bars on this graph show the return of the U.S. stock market for that year, and then the little blue dots show the average, or not the average, but the intra-year decline, like the lowest point of the U.S. stock market during that year. And this really helps because these downturns are common. They happen regularly, and that doesn't mean, when that happens, it doesn't mean that we're going to have a bad year, so to speak. It's just kind of part of investing. I mean, in order for investors to earn the reward that comes, they have to take some risk and kind of experience some of these drawdowns and intra-year declines when they happen. And keep in mind, the average return, the annualized average return of the U.S. stock market, since 1927 has been just about 10%. But in order to earn that 10%, you have to experience some negative years, and you have to experience some significant and large drawdowns, which are never fun to experience, and we're experiencing one right now. But they do tend to pass, and the market tends to recover. And that bottom bullet point's also interesting. 70 out of the 93 years in this data were positive, so that means that there's 23 years that were negative, and that is all both the positive years and the negative years play in to get to that 10% annualized average. Okay, before we jump into Social Security, I'm just going to leave everybody with a little bit of hope. So this shows the 25 worst drawdowns over the history of the U.S. stock market, and it shows that's what the light blue bars are with the negative returns, and then the positive returns that follow are the next year's returns from that drawdown. So historically, when we've had a drawdown, we've had a really, usually the stock market's recovered, and sometimes it's been very dramatic. And so the point here is stick with your plan, and the downturns are not fun, but they tend to go away, and and the market recovers quickly. And so it's virtually impossible to try and time the market, meaning jump out of the stock market when you think things are bad, jump back in when you think things are good. The stock market's forward looking in its prices, and so it's virtually impossible to try and play that game of timing. And so the prudent approach is to just come up with a well-diversified plan that fits your needs, meets your goals, while taking the least amount of risk that you can in order to meet those goals, and then stick with your plan and rebalance and tax loss harvest. And there's a few things you can do while the market's down. But the bottom line is to keep the emotions out and stick with your plan, and things will, we would expect things to get better. If you have any questions about the market or the economy, you can type those in. We'll try to answer those at the end. Okay, so I'm going to jump into Social Security. Social Security is one of the most important retirement incomes that Americans have. And there's a lot of, it's a complicated system. There's a lot of weird things in there and timing that you have to kind of pay attention to. And so I'm going to talk a little bit about how it works and what you should do about that. All right, so the biggest question is, when do you start receiving benefits? So you can start at your full retirement age, which we'll explain what that is in a minute here. You can start as early as age 62, and then you can wait until 70. And there's pros and cons to these, and you need to know the rules and how it affects you. But those are kind of that's the window to claim Social Security benefits is age 62 to 70, anywhere in between there. And there's really no one size fits all. So when I started doing Social Security analysis, I thought I knew the answer. You know, when somebody would come and talk to me, I thought I could just give them the answer that was best for them off the cuff. And I realized very quickly that each situation's unique, and you really need to sit down and run numbers in order to make the right decision. And when you take benefits, significantly can affect your retirement income, what your odds are of not running out of money, and just making your retirement as good as it can be. And then if you're married, it kind of double complicates everything, and so you really have to do some planning if you're married. All right, here's a few factors that you should consider when deciding when you should start benefits. So your full retirement age and your benefits, we'll get into how that works. The amount of your future benefit and the effect on the early or delayed retirement, your life expectancy, when you want to actually stop working. You know, if you're going to work longer, you probably don't really need to take benefits. If you're going to retire earlier, you may want to take benefits early, but if you've got other means to supplement your retirement, you might still could delay. We'll talk a little bit about income taxes and then spousal benefits. All right, so let's just explain how this full retirement age concept works. So the full retirement age is the age at which you receive a full unreduced Social Security benefit. And this started out at age 66, but when Social Security was first implemented, there was only about half of Americans lived long enough to even claim benefits. And so the system was really robust, and it had plenty of money coming in. But as people started living longer and our demographics changed as a country, then the system kind of became, you hear all the time that it's bankrupt or it's going to run out of money. And we can talk about some of those things, but what they had to do was push the retirement ages, the full retirement age, to 67, and that made some people upset. And so they got tricky with it and made it more complicated and added in all these, increments of 2 months. So depending on the year you were born, your full retirement age, it is what it is. But here's the chart, and that age is important because it's kind of the starting point for your benefit calculation. Okay, so to calculate your benefits, I guess the first thing I should say is to qualify for Social Security benefits, you have to have worked 10 years in the system and paid Social Security taxes. So that could be from a job that you were working and being paid as an employee and you had Social Security taxes being taken out of your paychecks. It could be self-employment income, but it's a 10-year, to be eligible, you gotta have 10 years in that system, and it's broken down by quarters. So it's really 40 quarters. And they don't have to be in order or anything, but 40 quarters of Social Security income to qualify for benefits. Once you qualify, in order to calculate your benefits, they take your highest 35 years of Social Security earnings, and they index all those for inflation, and that's the number that goes into the formula. So if you had, let's say you only worked 10 years, you would have 25 years of zeros that would go into that average. And if you worked 35 years or longer, they're just going to take the highest of the 35, the highest 35. Okay, so here's an example of kind of how the full retirement age works and how starting early affects the benefits. So in this example, our person here is their full retirement age is 66. Their monthly benefit is $1,800. They could start it as early as age 62, and if they do that, their benefit would be reduced permanently to $1,350. And it's not a 62 or 66 decision. You can really take it any time in between there, and the benefits are reduced. It's about 8% per year that the benefits are reduced. However, you would have, if somebody took it at age 62, they would have received benefits for a longer period of time, so you kind of have to factor that in. One question I get often is people want me to calculate what their break-even age is, if with different scenarios of claiming benefits. And I always caution people that that's the wrong way to look at Social Security, because in retirement, your biggest risk is longevity, which means living a long, long time and outliving your ability to pay for your expenses in your life and whatever it is you need. And so Social Security, by delaying it, that's one way you can protect yourself a little bit from longevity, because you essentially buy yourself a bigger monthly payment forever, for as long as you're around. Okay, here I'm going to show you what the impact is of waiting. So it's our same person here, age 66, their full retirement age benefit is $1,800 per month. Each year that they wait, they get an 8% increase in future monthly benefits, and those are called delayed retirement credits, all the way up to age 70. So our $1,800 monthly benefit is now almost $2,400. And that's a pretty big increase, and that increase lasts for your lifetime. And so you can kind of see the power of delaying Social Security benefits. And to put it into perspective, statistically 61% of retired workers, they rely at least 50% of their retirement income is from benefits. And so this is a big deal. And 60% of Americans also file early, which in some cases, there's nothing you can do about that. You just need to file. But in cases where you've got some flexibility, you've saved well, you can work a little bit longer, delaying benefits can make a lot of sense and can really be very impactful for somebody's retirement. This puts both those two together, so it shows you the full spectrum. Our same example, our person who's age 66, their full retirement age benefits $1,800 per month, and it shows you the difference between age 62 and age 70. It's $1,350 per month at 62, and almost $2,400 at age 70. That's a 76% more just from waiting those 8 years. Obviously, you had to give up $130,000 over that 8 years, but still very powerful. Delaying Social Security can be very, very powerful. All right. Social Security planning would be really, really easy if we all knew exactly how long we would live. Unfortunately, we don't, and so we have to guess, and we have to make a decision based on all the information we have, and then just kind of do our best guess and choose what fits best in our overall plan. But keep in mind, 1 out of 4 retirees will live past age 90, and 1 out of 10 will live past age 95. And I would expect these averages to continue to go up. I mean, I guess coronavirus throws some wrinkles into things, but if that gets taken care of, I would expect with modern medicine that these averages will continue to increase. And so that just adds to the complexity, and it makes delaying more valuable. All right, let's talk a little bit about how working affects your Social Security benefits. So if you claim benefits before full retirement age, the earnings from your job can potentially reduce your Social Security benefits. Once you reach your full retirement age, then earnings no longer matter, and there's no amount of income that you could earn that would reduce your benefits. And so that's one of the things to for sure consider. If you're going to work up until your full retirement age or maybe longer, it probably doesn't make sense to claim your Social Security benefits before that time. If you're going to retire, stop working before full retirement age, then where this could come into play is if you worked a part-time job in retirement, or something like that, started a small business, anything like that. So here's how the benefit reduction works. So before full retirement age, you really can only earn $18,000, and then once you get to that point, your Social Security benefits are going to be reduced $1 for every $2 that are over that limit. The year that you reach full retirement age, they give you a little bit of a bigger limit. It's $48,600, and then the reduction's not as quick. And that's just because people, they might not retire on December 31st. Maybe they retire, mid-year or partway through the year, and so they give you a little bit of a break there. And then again, after full retirement age, the earnings don't affect your Social Security benefits. All right, some things to consider. What retirement income will you have? So we talked about Social Security, job earnings, we talked about a little bit. If you have pension benefits, that's something to consider. And then what savings and investments do you have? And all these things need to be considered when you're deciding when the optimal time to claim Social Security is. Now to move on, just talk about taxes a little bit. Social Security benefits are taxable depending on your income level. So, most of our clients end up having their Social Security benefits taxed at 85%, but there's these couple of tiers here. So look down at the bottom here where I've got the asterisk. So your combined income in this scenario, in this calculation here, is your adjusted gross income plus your non-taxable income, like municipal bond interest, that sort of thing. And then half of your Social Security income. That's the number that you use to determine how much of your benefits are taxable. So if you are single and your income is $25,000, less than $25,000, then your Social Security benefits will not be taxed at all. If your income's between, above $25,000 but below $34,000, then 50% of your benefits are taxed. And if you're married, the limit's $32,000 to $44,000. Once you get over that upper end limit, then 85% of your benefits are taxed. And I want to just be clear here that those percentages is not the tax rate. That's the amount of the benefits that get taxed, and the tax rate would be whatever tax rate that income falls on your tax return. So, and that's going to depend on what other income you have going on. So sometimes I get people worried that 85% is the tax rate, and that's not the case. It's 85% of the benefits get taxed at your ordinary income tax rate. Okay, I'm going to talk a little bit about spousal benefits now. If you're married, your claiming decision definitely will affect your spouse's benefit and what's available there. And so how that works is your spouse is eligible if they've worked during their lifetime and they have qualified, so they've worked the 40 quarters, then they would qualify for their own Social Security benefit based on their earnings, and they would have their own average. You know, their own 35 highest year average would go into the calculation on how much benefits they would be eligible for. There's also a spousal benefit, and that is 50% of the higher earners, the higher earning spouse's Social Security benefits at their full retirement age. So if we go back to our example of our person who was 66, their full retirement age benefit was $1,800. If that person was married, their spouse would be eligible for 50% of that benefit, which is $900. And if your spouse has their own benefit, they don't get both of those. They get whichever one is higher. And so spousal benefits can play a pretty big role, especially if you've got a spouse that either didn't work or worked part-time or something. The spousal benefit's most likely going to be a lot better than their own. Keep in mind, the spousal benefit, it does not earn the delayed retirement credit. So in our example, our $900 spousal benefit, it'll be capped. That's the highest it could ever be. And then what happens is when the spouse goes to claim it, two things you have to remember. So the higher earning spouse has to be claiming their own benefits in order for that spousal benefit to be available. And then Social Security will look at the age of the spouse who's claiming the spousal benefit. And if they claim it at their full retirement age or later, then they'll get the full benefit. If they claim it before their own full retirement age, then they'll have an 8% reduction each year that they claim it early or before their full retirement age. So the spousal benefit, it gets the penalties or the reductions for claiming early, but it does not grow past full retirement age. All right, and survivor benefits. So, once you've started claiming Social Security benefits, if one spouse dies, then the remaining spouse gets the higher of the two benefits that were being taken. So, which is going to be the higher earner's benefit, including any amounts earned for delayed retirement credits. So, if you're wanting to protect your spouse and give them a higher monthly benefit for their lifetime, then delaying will buy you a higher monthly benefit for your lifetime, but it'll also buy your surviving spouse a higher monthly benefit for their lifetime. If you've got a spouse that dies before they're taking benefits or before they're retired, there are some survivor benefits available, and those start as early as age 60. And there's also, if you have a young person die that has children at home or dependents who are disabled, there's some benefits available while raising children as well. All right, so Congress has made some changes. So I'm going to just kind of talk about the sustainability of the Social Security system for a moment here, because you hear all the time that it's bankrupt, it's going to run out of money. And what are people really talking about there? Well, Social Security is a pay-as-you-go system. So what that means is workers right now, who are out there earning wages and having Social Security taxes taken out of their paychecks, and their employees or their employers are matching the Social Security, those Social Security taxes go in to pay current benefits. As of 2020, there is more going out than there is coming into the system, which is not a good thing to have happen. If you think about that from a family checkbook perspective, you never want to have more money coming out than you have coming in. So the system's in a little bit of a critical state here. Now, it does have $2.8 trillion in a trust fund to help with, shortfalls. And that $2.8 trillion trust fund is invested in U.S. Treasuries. And so it's earning interest. About 10% of the revenue of Social Security comes from interest, ends up being like $90 billion, although that will probably come down with Treasury rates being so low. But that trust fund, with the latest projections, is supposed to run out by 2034. Well, what does that mean? That doesn't sound good. It means that Social Security would only be able to pay 75% of what it's supposed to pay going forward. And so there is a potential that benefits would be cut by 25%. Personally, I think what will happen is Congress will make some tweaks to the system to make it work. So some of the things they could do are push the retirement ages, longer, and that's probably likely to happen. I mean, they've done it once before. The other thing that they could do is raise the tax rate. I've heard that a 1% tax rate would make the system sustainable going forward forever. I'm not in favor of tax rates, but if it meant that grandma could get, her full benefit, I'd probably be for it. And so there are some things that Congress will have to do. It's very political, so we don't see Congress wanting to tackle that as like they should. But my thoughts are that they'll figure it out, and Social Security will continue going forward. And at a minimum, if they don't do anything, it would still be able to pay at least 75% of the benefits. So there used to be all these changes or these tricks you could use to maximize Social Security, and Congress has actually closed most of the loopholes. This one here is still available for a selected few if you were born before January 2nd, 1954. And how this strategy works is one spouse files for their own retirement benefits, and then the other spouse files a restricted application for spousal benefits only. And what that does is it allows that spouse's benefit to keep growing, their primary benefit to keep growing, but they're still getting a little bit of Social Security income while their benefit's growing. So if you fall into that age, then definitely you'll want to talk to somebody and see if it's a good strategy for you. And then, yeah, obviously once you get to the point where you want to switch over to the higher benefit, you go ahead and do that, probably most likely age 70. All right, so here's a couple factors to consider, and then we'll take some questions if there are any. So you might want to take benefits early if you need the income right away. Like I said earlier, if you're done working and you need benefits to make, to retire, then you don't really have a choice. The second bullet point, you want to invest your monthly benefit. I would caution away from this because the government gives you an 8% guaranteed monthly increase. That's impossible to find in the market, and I don't know any investment that would pay anything near that rate of return. And so I'd steer clear of that one. And then again, you don't know your life expectancy. If you end up living a long time, then by delaying, you buy yourself a bigger monthly payment forever, and it's government guaranteed, and you just can't beat that. If you want to delay taking funds from your other retirement vehicles, or if your spouse wants to delay. And then some of the factors that might go into a decision to delay benefits. Higher monthly income we've talked about. You want to maximize survivor's income, which is a very key concept to think about. So I've had clients who have, unfortunately been diagnosed with terminal illnesses, who it still makes sense for them to delay benefits because they want to buy their spouse a higher monthly benefit after they're gone. And so even if your life expectancy is short, you really need to look at joint life expectancy if you're married in order to make the best decision. If you plan to work longer, obviously there's no reason to go in and claim benefits if they're just going to be reduced because of the earnings penalty. Working longer also really helps retirement, in an overall retirement plan, because you don't need, the longer you wait to start drawing Social Security and then to start taking money out of your retirement accounts, then the less you really need overall. And so working longer makes a huge difference in a retirement plan. And then if you're able to do that trick that was, if you're born before 1954, then obviously you'll want to wait and kind of maximize your benefits with the spousal benefits. Okay, so what do you do in order to figure out what your benefits are when you're ready to get started? So everybody can go to it's SSA.gov or socialsecurity.gov and can sign up for an account to look at what an estimated benefit would be for you. You don't have to be near retirement to do this. You can just go in there and create an account and get your earnings history. You can make sure that's right. You can see what kind of benefits you have available and kind of track things going forward. Social Security used to send out, every so often they would send a little thing in the mail that showed your estimated benefits and your earnings history. They've moved all of that online. So in order to get those, you have to go online and create an account. And then when you're ready to take benefits, it takes some time to get the application in and everything. You have to apply online now. But you'll want to do it 3 months before, not before you reach age 62, but really 3 months before you want to take your benefits. I would encourage people, at Squire, we run an analysis for people that shows we can come up with an optimal strategy based on what your earnings history has been, whether you're married or not, what the age differences are between you and your spouse, and that sort of thing, and give you a plan that will help to maximize your benefits. So if you're interested in that, reach out to us. We're happy to help there. And this says apply by phone or in person, which you can't really do in person anymore. Yeah, all applications are online now. Okay, I think that's all I had for Social Security. Again, if there were questions about the market or the economy, we're happy to answer those as well, but we'll just jump into question and answer now. Here's a disclaimer that I'll leave up that just says this is not specific advice. So if you need specific advice, you need to talk to a professional, and we're happy to help there if you'd like us to. All right, let's see if we have any questions.
So Nathan, there's a couple of questions.
Okay. Do you want to just read them to me and I'll?
Yep. Okay. Yep, let's do that. All right, first question says, I'm confused by spousal versus survivor benefits. Is the difference based on whether the deceased higher earning spouse has reached retirement age or started taking Social Security when he or she passes away? Okay,
great question. So they are two different benefits. So spousal benefits are available while your spouse is alive. So you would, if in a married situation, let's say you got one spouse who's a higher wage earner, they're collecting their own benefits, and then their spouse is collecting a spousal benefit on their earnings record. You would get both of those benefits while both spouses were alive. When one spouse passes away, if it's the higher earner's spouse, then the spouse who is remaining will just their spousal benefit will stop and they will start getting the higher one, whatever their spouse was getting. If the lower wage earning spouse passes away first, then that benefit just goes away and the higher earner spouse just continues collecting their own benefits. So you got to think of it as two benefits. When one spouse passes away, whichever benefit is higher, that benefit continues until for as long as the surviving spouse is alive.
Okay. Next question. If you wait to gain full retirement until 70, does your wife lose her half for 4 years?
Yeah, so good question. That is true. Now it's a little bit more complicated because you have to look at the age of the spouse. So if the higher earner waits till age 70, that's good because they're earning those delayed retirement credits. But in order to free up the spousal benefit, they have to be, the higher earning spouse has to be claiming benefits. So let's say spouses are the same age, that's a case where you might not want to delay taking benefits because taking benefits at full retirement age will free up the spousal benefit, which would be half of those benefits over the 4 years like they indicated there. And so that's a case where you might not want to delay and you really need to think about it. Now, if your life expectancy is really, really long, it'll still make sense to delay and give up that 4 years of spousal benefits. But if your life expectancy is in the average range, then it probably makes sense to take benefits right at full retirement age to free up the spousal benefit. Now, the other thing that would come into that decision would be, did the spouse do they qualify for their own benefit? Because if they do, then what you could do is have the higher earning spouse delay until 70, and you could have the lower earning spouse claim a benefit on their own earnings record, and then kind of switch. If the spouse benefit's higher, they could switch at age 70 when the higher earner spouse starts claiming benefits. So that's a good question. If you're in that situation, feel free to reach out to me personally. I can talk through it with you on the phone, or we can run numbers for you.
Okay, let's see. Here's another one. It's written. I'm going to see if I can kind of revise the way it's written a little bit. So hopefully I make sense, but we'll see. I will be 65 at the end of this year, and I'm still working. Do I need to report to the Social Security office? Some have said that I need to wait, or that I need to 3 months before I reach my birthday, or within 3 months after my birthday. Otherwise, there's a penalty. Is that true?
Yeah, so that's a Medicare question. Social Security there's no requirement at any age to go talk to the Social Security office or apply for benefits or let them know. The only thing you'll want to do is make sure you give yourself at least 3 months before you want to have benefits start to apply. Now, Medicare is a different story. Medicare, you're eligible for Medicare at age 65, regardless of whether you continue working or not. And Medicare, you do want to go and talk to Medicare before age 65 to see if you need to get on it or not. And that decision would be based on if you had coverage, health insurance coverage somewhere else. So, if you're working and you're on a group insurance plan at work, you probably still want to go price out Medicare, and you might want to talk to your HR person at work and try and figure that out. The answer, you might jump on Medicare, you might keep on the work plan. There's just kind of both options, but yeah, that's a Medicare question and not a Social Security question.
Okay, great. Thanks, Nathan. It doesn't look like there's any more questions coming in, so we can go ahead and wrap up. If you guys do have any follow-up questions, feel free to reach out to us. And just a friendly reminder that there are some links in the question and answers. The slide deck, PDF version, as well as a recording of this webinar will be sent out to all registrants later today. And thank you all for attending. Anything else you have to say, Nathan?
No, stay positive and enjoy the journey. This is kind of a rough time in our with the economy the way it is and with coronavirus, but it'll get better. Just stick with it, and we're here to help when needed.
All right, thanks everyone.
Thanks.